Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Greg Carpenter, and Greg is the Managing Director of BTI Group M&A, which is short for Mergers and Acquisitions. It's a business brokerage firm located in San Jose. And he's been a business sale intermediary since 1985. The current focus of the business is on the middle market, valued from $1 million to $50 million. He was on the board of directors for the California Association of Business Brokers for 9 years, and Greg is a frequent speaker about how to sell a business. He is an arbitrator for the California State Bar and the Santa Clara County Bar Association. Greg also has a great home at Incline Village at Lake Tahoe that he doesn't get to use very much. So if you get in touch with Greg, it may be available for rental. Anyway, today Greg and I are going to talk about preparing to sell a business. And as we get started, I'll just caution our viewers, this is just some highlights. Buying a business is a complex matter, and I guess the big part of our message is that buying or selling a business, you need to have good professional help on the way. Welcome, and thanks for joining me, Greg.
Well, thanks for having me here, Mike.
Okay. So what are some ways that buyers and sellers use to determine a value or a sales price for a business?
There are benchmarks, and one most common approach is the market approach, where data from comparable sales of similar businesses are used to calculate price to revenue ratios and price to earnings ratios. And then the metrics of the subject business are used with these ratios to calculate a range of values. Mm-hmm. There are also rules of thumb, and depending on the type of business, some people are really academics and try to be very precise about valuations, and others are gunslingers that just try to bluff their way and get what they can get. So it's all over the place.
Right. So I think an awful lot of this is how fortunate are you in matching up with the right buyer. So if your business is going to make a real complement to their business where they can see that there's some real synergies there, or maybe you're a competitor that they just as soon get out of the way, so maybe they're willing to pay a premium to do that. In that case, you may be able to get much more than what you'd otherwise compute.
Those are good points. And if it's business to business acquisition, a good way to help the seller get the higher price is to run an auction type sale, mm-hmm. in which there's no asking price, and you market the business to all the buyers you can identify at once, sending out often hundreds of letters and phoning all of them and getting the confidentiality agreement signed, information in the hands of all the prospective buyers you can find, not only corporations but private equity, and trying to create a bidding war. This isn't always possible. Many businesses are not desirable enough to have multiple buyers at once. But when it happens, it can be very good.
Yeah. Okay. What are some important assets and liabilities that might not be on a company's financial statements?
Well, I think a big obvious one is operating leases.
Mm-hmm.
If they're using equipment that they don't actually own, and it's not a capital lease where they're going to own it at the end of the lease, it's just like a rental. You probably can think of a few.
Well, I was thinking more of the asset side, and so there's this thing that we call goodwill that sort of encompasses a lot of intangible assets, and it won't typically make it onto a business's books unless there's been a sale. And so in that case, because maybe it's been identified as an asset, then there may be something there. But even then, that's where the value. In fact, that is some people says that's really where the business is. That's what it is. it's in essence, it's the customer list.
Yeah, well, goodwill is, I think there's an accounting definition of that, and it's generally the value of the business over and above the tangible asset value. And as you say, goodwill is not usually on the books unless the present owner had bought the business, and in the allocation of purchase price, they did allocate part of the purchase price to goodwill. But even so, the business might be worth a lot more than when he bought it.
Oh yeah.
So it's still not going to show all of the goodwill.
Right. And like I said, so goodwill, it can encompass a lot of intangibles. It could be even a favorable lease.
The value of trained employees in place is another section of their goodwill can be broken down into several components.
Yeah. But probably the most important thing that I wanted to bring to the front again, I think it was Andrew Carnegie that once said, hey, you can take away everything. If you just give me my list of my customers, tomorrow I'll be back in business. And so the business is all about the customers. And a lot of times the hidden value in that customer is what back end can you bring? And maybe the person that's there now, like we said, we were talking about complementary businesses before. So maybe this person that's been operating the business has been focusing on a certain service that they're very good at or whatever, but then there may be a lot of additional things that you can bring to the party that can really increase the value of that business. So it seems like we're talking about buying, they sort of go together. But anyway, but as a seller, sometimes you can bring these things to the attention of the buyer. You say, I think that there's a lot of potential here related to my business, and here's why.
Sure. And all buyers aren't going to value the business the same. And it's because of that very point you just made. If one business is acquiring another, and there are some points of synergy, then it's going to be worth more to that synergistic buyer than it would be to someone who's just a financial acquirer and is going to have exactly the same position as the seller. Great example of that is a global company that has a global sales force and distribution network acquiring a local or regional company that has a great product but hasn't ever sold it out of the region. As soon as that global company buys that local company and puts that product into their global sales and distribution network, the sales can go up by 10 times. So it's going to be worth a whole lot more to that buyer than it would be to just someone who's going to buy it and be just like the seller sitting there selling it locally.
Right. So I had a brother-in-law that had a business doing repairs related to cable television. And so he had run this business for years, but basically at break even. I mean, he was making virtually nothing. And then out of the blue, he just made a connection. I think it was with one of the cable television companies that was interested in the business from that aspect. And they paid him $1 million for nothing.
Good for him. He hit the jackpot.
Yeah,
but that's really unusual.
It is unusual, but again, like I said, if you can find the right buyer, sometimes things just work. Sometimes it doesn't.
Maybe what they wanted was that customer base, and then they were going to sell those customers a whole range of other stuff. So they would make a lot more money than he did.
Absolutely.
So the type of value that we're talking about when a financial acquirer is just going to go take the place of the present owner, that's typically fair market value. When a strategic buyer who has synergies is buying it, we call that investment value, which is the value that's unique to that particular buyer because of his synergies.
Right.
So fair market value is typically less than investment value.
Should a business be operated differently when you're preparing to sell it?
It depends on how you're running it before you get ready to sell it.
Okay.
Some people who are very prudent plan the sale of their business from the day they start it. They organize it, structure it, and document it to be to maximize the value and the marketability at all times. Other people run the business for their convenience and their lifestyle. those people need to think about how to restructure it to sell it. Typical risks that they ignore, which buyers will not ignore and will reduce the price they're willing to pay, are things like having 80% of your sales to one or two customers.
Uh-huh.
The seller may know his relationship with those clients is really great, and as long as he's in business, they're going to keep buying from him. The buyer doesn't know that. The buyer doesn't have that relationship. To the buyer, that's a huge risk.
Uh-huh.
If he buys the business and all of a sudden 70% of his sales go away, he's going to go belly up.
Uh-huh.
So to the buyer, it's a huge risk. To the seller's all comfortable with that. He doesn't care. Nobody's going to buy it unless the seller is going to carry some of that risk. And typically, that involves a variable purchase price where the seller only gets paid if those customers continue to buy from the business. And another thing that entrepreneurs do that professional business owners don't do is they don't really bother having good books and records. The value of the business is tied directly to the seller's ability to prove and the buyer's willingness to believe the business performance. You can only do that with great books and records. So you really need to have a great CPA advising you and checking over your work, making sure your procedures are correct and that your statements are all reconciled and that your taxes are timely filed and done correctly if you ever want to realize the value out of your business.
Mm-hmm. Okay. So what or who are good candidates for suitors to buy a business?
Again, depends on the business. If it's a little mom and pop storefront business, probably another person.
Mm-hmm.
If it's a company that has a legal requirement that the owner has to have a certain license, for example, a physical therapy business
Uh-huh.
or a dental practice,
Uh-huh.
then the buyer has to have the physical therapy license or the dental license in order to own that business. So it limits the universe of buyers, but it also helps you identify buyers.
Uh-huh.
If the business is a little bit larger business, then the buyer would need to be more affluent and have more money for down payment, closing costs, and working capital, and be willing to do some financing. Or if it's even larger than that, say in the $2 million of earnings and up businesses, it's probably either going to be a corporate buyer, which is likely to be the strategic buyer,
Mm-hmm.
or a private equity firm, which typically will have millions, hundreds of millions to even $1 billion or more of equity for the purpose of buying and growing companies and realizing profits on them down the road.
Uh-huh. Okay. So if you're going to sell your business, what communication should be done for employees?
The most common practice is to keep it secret from employees, customers, and competitors and vendors until the day the sale is closing. And at that point, you would announce to everyone that you've now merged with XYZ company, or the company has been acquired, or whatever the thing is, and introduce the new owner to the employees. In the case of vendors, if there are some sole source critical vendors, or if you have purchase agreements with those vendors, the buyer may insist on contacting them during the due diligence process as part of approving their purchase for the business. And also, if there's a management team, key management people may need to be brought into confidence about the sale, because the buyer is going to need to interview them and make employment agreements with them as a condition of closing the sale. So most frequently, nobody knows until closing. The bigger the business, the more people have to be brought into the process, but everybody needs to be sworn to confidentiality.
Mm-hmm. Don't you think it would be a good idea to get legal advice related to this issue as well?
Legal advice, financial advice. The seller is going to experience a liquidity event in which he has receipt of a large amount of money all at once. So he needs tax planning advice. He needs advice from a financial planner and a wealth manager.
Mhm.
Often there will be financial entities created a significant time, 6 months or even a year before the sale, to enable transfer of those funds to that entity that will benefit the seller without giving a whole lot of it to the federal and state governments in the form of tax. If you wait until you've got an offer on the table, too late to do some of these things.
Yeah. So part of what I was thinking about when I asked the question too, though, is that sometimes there are legal requirements, especially for larger corporations, and even more so when they have union employees. So a lot of times they have, I think, some notice requirements, particularly if a location is going to be closed or something like that.
That's right. There are federal and state regulations about that. And some other businesses also have state regulations requiring notifying the customers. For example, child care, preschools.
Okay. I guess we haven't got to this yet. Should I hire a business broker to help sell my business? And what can I expect to pay? What are the benefits for using a business broker?
Okay. Well, the answer, of course, is always it depends.
Yeah.
If the owner of the business has been through dozens of sales because he's a serial entrepreneur and he has a legal team that's experienced in transactions, and even his management team includes people who are former investment bankers and now they're his employees and things like that, probably not. On the other hand, if it's the first time an owner has sold a business, or even the second or third time, and maybe the business this time is a lot larger than he's ever sold before, even if he has a buyer who's approached him and he wants to do the deal, probably a great idea to have a business broker advising you and representing you. Some of the reasons why are, of course, to make sure no one takes advantage of your interests, but also to be a buffer between the buyer and the seller. Sometimes negotiations can be quite heated. Some buyers' tactics include a lot of inflammatory rhetoric, and we might think of some well-known person who does a lot of that.
Yeah, I want to have a buffer if I was dealing with the current
Exactly, and so it's part of the broker's job is to filter out the inflammatory rhetoric and deal with the content, so that the parties can think rationally and make rational decisions and not be put off balance and make an emotional snap judgment that is not in their interest. Brokers can also advise on valuation. Brokers also have a portfolio of advisors that they've accumulated over the years that can help the seller solve almost any business problem to prepare the business for sale and to make it more valuable and more marketable. That those advisors might include marketing consultants, multi-state tax consultants, HR consultants, and bankers and strategic planners, on down the line. Any kind of business problem an owner might have, a good business broker should know someone who can help him solve that problem. The process to prepare the business for sale, for those who do prepare, can take 1 to 3 years, depending on the condition of the business when you start and your ultimate end goal.
Wow. Okay. Do I have let's say I'm going to buy a business. Do I have a continuing exposure to business liabilities? Excuse me, I'm selling my business, the other way. Yeah, certainly if you're taking it on, you're going to be taking on those liabilities in most cases. But do I have a continuing exposure to business liabilities after selling a business?
Yes. And that exposure will vary according to whether you're selling the assets of your corporation or whether you're selling the shares of stock of the corporation. In every purchase agreement, there are usually seller's representations and warranties. They're basic, obvious things for the most part, like representing and warranting that you actually own the assets that you're selling and that you can deliver them free and clear of any liabilities. The terms of the agreement typically require the seller to be responsible for all liabilities and operating expenses of the business up until the point where the business is transferred to the buyer. And of course that the buyer becomes responsible after. But the buyer is only going to be responsible for the seller's liabilities to the extent that those are listed and agreed in the purchase agreement for the buyer to assume. If you're selling the stock of the corporation, you have more exposure than if the corporation you own is selling its assets. And the reason why is that the corporation itself is an entity capable of doing business. And so when a buyer buys the shares of stock, he's going to own that entity, but it's possible a claim might arise from the time when the seller owned the business. Now the corporation still has to deal with that, even though it's now owned by the buyer.
Right.
So the seller is now personally liable, whereas before there might not have been recourse to him personally if his corporation were selling its assets.
So I think what you're saying is that he's made some warranties again in the agreement, because usually the corporation is responsible for its own liabilities.
That's right.
And there's a shell around the corporation that's supposed to protect the shareholders. That's one reason
right.
for having.
An example, and the one that's typical, is since the seller is warranting that there are no claims that are going to arise after the buyer takes over, if suddenly you get a little letter from the IRS that says, guess what, we're going to audit last year's tax return from when the seller owned the business. And it turns out there's a big tax liability. And because of what they found in that audit, oh, guess what, we're going to go back several more years. And it turns out there's this huge tax liability because the seller was doing some unacceptable practices in filing his tax returns. Well, guess what, the buyer's on the hook for that. But the seller's represented and warranted that there weren't any such claims and that he'll indemnify the buyer for those claims. The buyer has recourse to the seller. The seller's on the hook to take care of it, but he's on the hook personally for that.
Right. Okay. So again, it's basically because of the warranties that he made related to the sale.
Exactly.
And another thing to think about related to this, and the reason for getting tax advice, is sometimes you sort of inherit the tax attributes, if you will, when you buy a corporation. So for example, one that I used to deal with quite a bit is auto dealers. Okay, so many of them have what we call LIFO inventories. And so it's a way of accounting for inventory where...
last in, first out.
Last in, first out. And so what in essence what it does is it creates a cost of living adjustment back to maybe when you originally started the auto dealership. And so you may be pricing cars, if you have a dealership that's been in business for 50 years, you may be carrying automobiles for $2,000. For back at that time, you could buy a pretty nice car for that. And so then if that inventory gets liquidated in the future, then it's creating a tax liability. So you need to understand how these things work and have tax advice related to it, I guess is what I'm trying to point out.
Bottom line, don't try to do this at home. Get professional advice.
Right, right.
In many areas.
So maybe why don't we go ahead and talk about some of the advisors who should be involved with putting like a sale together.
So typically the M&A advisor or the business broker is the project leader for the process. And it begins with the owner thinking about his life and his lifestyle, and is he ready to make a transition? Is his family ready for that? Does his wife really want him to be home every day? If all those things are yes, and if he's talked to his personal financial planner, who is one of the people who should be on the team, and he decides, okay, let's look into this process, he needs to figure out how much his business is worth versus how much his financial planner says he needs to get in order to realize his lifestyle income requirement. He needs to decide whether or not he also has a legacy requirement. In other words, does he want to have enough more money than what it takes for him to live on that he can leave some to his children? Mm-hmm. And he may even have a philanthropic goal, which would be over and above that. So then he needs to figure out, well, what is the business worth? So that's a good time when then the business intermediary can give him a rough idea, or you can refer a third-party business appraiser. Then if the business is worth enough, then you'd go into the process of getting it ready to sell, packaging it, repairing anything that needs repairing, making it presentable, making any changes in staff that you think are required. And if it's not, then you need to go into the process of value building, in which case the broker can point out some obvious things, but typically would refer in a consultant who specializes in value building.
Okay.
And you try to set a timeline and work for that. You'd need to make sure the company's books and records were in order. You'd need to make sure all the corporate documents were in order, that all the annual meeting minutes are up to date, all the corporate filings are up to date, and that the corporation is listed as active on the Secretary of State. Any pending litigation needs to be cleared up. Any claims need to be dealt with. And in general, you need to reduce any big risks like concentration of sales in a few customers. Need to get a lot of customers. Concentration of supplies in one vendor that you can't get a supply anywhere else, that's an issue. And any other issues that are holding the business back, to do the best you can to either be able to explain them and so the buyer will accept them, or to deal with it so that the risk goes away. Once the business is in the shape to sell, then complete documentation package should be put together, including as much of the due diligence documentation as possible. Because old axiom in our business, two things kill deals: delays and surprises. If you don't have all the documentation until the buyer's made an offer, then it takes time to gather the documentation. That's a delay. And then if it doesn't match the buyer's expectation, that's a surprise. Usually not a good one.
Mm-hmm.
So you should have your legal advisor, your financial advisor, and your business broker should run the process. You should get up to speed on what purchase agreements look like, and don't be shocked when you get a 50-page purchase agreement that some lawyer drafted. And then we should handle the confidentiality issues, disclosures, offer and agreement, negotiation, buyer selection, marketing, all that stuff has to happen. And the intermediary runs all that for the owner, while the owner focuses on keeping the business profitable and growing and well organized.
Okay. Greg, I think we're about out of time.
Oh my gosh, again.
Yeah, time flies.
It does when you're having fun.
So I want to thank you again for joining me
Well,
here
thanks,
today. We appreciate your background related to this. Big topic, folks. We could be here for a lot longer. They have whole day seminars on these types of subjects, but we wanted to just introduce you. We'll see you next time on
Thanks, Mike.
Financial Insider Weekly.